Welcome to the Independent Advisors Podcast, where we dive into the world of stocks, tradable markets, and financial planning with Jessup Wealth Management's Chief Investment Officer, Mark McEvily, and CEO, Matt Jessup. You'll hear tips, tricks, and strategies to address your financial well-being and, most importantly, conveyed in a way that everyone can understand. Here are your hosts, Mark and Matt.
Hey everyone, welcome to episode number 157 of the Independent Advisors Podcast, where Matt Jessup and I, Mark McEvily, bring you everything you need to know from the past week in the world of financial markets and financial planning. So welcome back to the show, Matthew.
How's it going, Mark?
How was your break from podcasting?
Busy.
We were talking about just before we sat down. I'm not used to seeing you sitting across from me. It's usually Nicholas these days.
I'm looking forward to this one. I got some good content. I might have a rant or two for you.
Okay. I'm sure everybody misses that. So before we begin, as always, just want to take the first few minutes to recap the performance for the month and the year of the major indexes that we track. And these numbers are as of the market close on July 6th. And this data is from YCharts. S&P 500 index up 1.22% for July and down 19.61% for the year. The Dow up 0.63% for July and down 14.78% for the year. The NASDAQ Composite Index up 2.66% for the month and down 27.63% for the year. The small cap Russell 2000 index up 1.95% for the month and down 22.45% for the year. Vanguard International ETF ex United States down 1.88% for the month and down 20.34% for the year, which is interesting because I think a lot of people coming into 2022, there was like a rah-rah rally that international was going to outperform.
How many times have you heard that?
I've heard that a lot of times over the past decade, to be honest.
Yeah.
So that's not come to fruition just yet. Not
What's
saying
the saying?
it
A
can't.
Broken clock's right. 2 times a day, man.
That's right.
Eventually they're going to get it.
So eventually they're outperforming, but not right now. Really interesting on the yield front, Matt. The 3-month T-bill yielding 1.9%, so bumping up against 2%. Annualized yield. The 2-year Treasury yield currently sitting at 2.82%, and the 10-year Treasury yield at also 2.82%. So we had a brief inversion, I believe, yesterday and Tuesday on the 2 and 10 years, again signaling that, or at least the bond market is signaling that there's more risk in the near term than there is 10 years down the road.
That's right. And usually it's associated as a preview that a formal recession is somewhere in the near term.
Right.
Usually.
Exactly. Yeah.
Now, the thing that I like to when I see this for our viewers and listeners, I want them to visualize a yield curve that is flattening, right? That's what I want them to visualize with this. Because a couple of weeks ago, you had the 10-year that was almost at 3.5%. Mm-hmm. And in a couple of weeks, you go from 3.5% down to 2.82. I can't emphasize enough how major of a move that is in 2 weeks. That is massive.
Right.
That's like the stock market in 2 weeks going up or down 10%. And it's just a massive move.
Yeah, and it's not indicative of a normal environment, right? Because the longer you go out on the duration for these bonds,
you should be compensated.
You should be compensated because there's more risk, right? There should be more stuff that's able to happen within a 10-year period than a 2-year period.
Exactly.
But, this is quote unquote one of the recessionary indicators that, once the 2-year treasuries are yielding more than the 10-year, that, again, there's a recession on the horizon, which we've been talking about. And looking back at it, we might even be in one right now. We'll see when we get a GDP print later this month.
Yeah, it wouldn't surprise me, if you fast forward, say, 18 months, the Fed's probably going to go too far in the hiking of interest rates to control inflation to where the second half of next year in 23, they could be in a lowering cycle again. Mm-hmm. And that's actually a base case in my mind.
Yeah, I think so too. Moving on to big headlines, current events from the week. The Biden administration is considering dropping the tariffs that have been in place since the levies were enacted in 2018 by the Trump administration. So this could ease consumer prices even further in the U.S. as there be access to cheaper input costs, right, for products here. So again, wouldn't surprise me to see the tariffs get dropped shortly before the midterm elections to try to gain some political steam, I guess, for the current administration. But I'm kind of surprised that they didn't do this earlier, because I think that's one easy win for the administration would be just to drop those tariffs, right?
Yeah, it's been in their back pocket for some time, and the timing makes you kind of wonder, but I'm sure it is tied to the midterms.
Yeah. Number two is here we go with the probabilities.
There you go. You love these.
The odds
He's going to go nuts on this
of
one.
a U.S. recession in the next year are now roughly 1 in 3 after consumer sentiment hit a record low and interest rates surged, according to the latest forecast from Bloomberg Economics.
Even had a good word there for you. Surged. It's got we have probabilities, Jenna. We have words that are just enticing, Mark. This is the perfect headline.
I hate this stuff. So they're saying there's a 38% chance of a recession within 12 months. So, and the probability model incorporates a variety of factors with housing permits, consumer survey data, treasury yields. So according to Bloomberg, there's a 38% probability of recession in the next 12 months. So
I'd say it's higher than that.
Yeah, I probably would too. So take that for what it's worth. Moving on to tweets, articles, and research from the week. First thing I had was a research piece from Top Down Charts with first half 2022 returns for major index classes. And Jenna will throw this up on the YouTube stream right now so you can see what I'm talking about. But it just outlines the first half performance for 2022 of major asset classes. So, the thing that Callum points out here is virtually nothing works outside of cash and commodities.
This is a very important chart that if we have listeners that are listening to the audio portion of this podcast, they got to look at the show notes on this one, because what you're about to verbalize doesn't do it justice unless you visually see this chart.
Right. And I think the big thing coming out of here is TIPS, Treasury Inflated Protected Securities. By the means of this chart, we're down close to 15%.
How's that work?
And those are supposed to work during periods of inflation, right? So they're really...
I'm chuckling because everything's correlated the same way.
Yeah.
I don't care if it was you thought it was conservative or you thought it was aggressive. Everything got nailed.
Right. And I'm going to touch on that here in a little bit. But yeah, there was really no place to hide unless you were in cash, right?
Yeah, and someone could sit there and say, well, look at commodities. Commodities are getting slammed right now as we speak.
Yeah. There a lot of commodities have come in, anywhere from 10 to 20% just in the month of June alone. Right now.
Alone, wheat's down almost 30 since its peak. Corn's down like 20.
Yeah, oil's down, aluminum, iron ore. A lot of these input products in the manufacturing process have come down significantly.
And people are concerned about an economic slowdown.
Right. So the Fed can control demand side inflation, but they really can't control supply side, right? So things like energy, right? They can't, we had our Zoom market webinar last night, and I was talking about how the Fed cannot drill more oil and the Fed cannot end the Russia-Ukraine war.
Yes.
Right. So they can't solve that problem. But domestically and internationally, stocks and bonds got whacked. All cap levels, large, mid, small.
I mean, the way I categorize it is anything that's kind of stock related, you're down around the 20% range, some more, some maybe a little bit less. The fixed income range, you're down 15%, some more, some less. I mean, year to date, it's a bloodbath.
Yeah, it was. So I think a lot of people were happy to see the first half of 2022 come to an end.
Yeah.
Next, I had a tweet from Callie Cox. This was on June 30th. She said, yes, we're on track for the S&P 500's worst half of the year since 1970, down 21%. Oof. But in the S&P's history, first halves down 21% or more have always led to second half rebounds. So she said in 1932, the S&P 500 was down 45% in the first half. So if people think this year was bad, more than double it to be down 45% in 6 months.
Yeah, that's the definition of a depression.
Yeah. So in the second half, though, the markets rebounded 56% in the last 6 months of the year. In 1962, S&P 500 down 23% in the first half, up 15% in the second half. 1970 down 21% in the first half and up 27% in the second half. So, people might question why I think this is a piece of positive news, but again, I sound like a broken record when I say this. I think a lot or most of the damage has already been done, and just using history as our guide, I think that the probabilities are with us that the second half is going to be stronger than the first half, although nothing's guaranteed. Anything can happen. We can continue to slide. But I think as the inflation comes down and as the Fed continues to raise interest rates and consumer prices comes in a little bit, I think this sets up for a typical midterm election year where we're weak in the first half of the year, markets stabilize late summer, early fall, and then we get a run up into Q4. And after the midterm elections, through about a couple months before the next presidential election, tend to be one of the strongest periods in the election cycle. So we've been talking about, typical midterm years and how that plays out. And right now it's playing out like a typical midterm year. But I do think, once we get past this, get this recession over with, I think that markets are going to return to normal, and we'll start to see some pretty good returns going forward.
Well said. I would add, for flavor for the viewers and listeners, the market will bottom and start to rally well before the broader economy is appearing to get better. Mm-hmm. And so the warning, and this is a very important point for our viewers and listeners, let's say the market bottoms before the midterms, okay, and starts to rally. Main Street America, it might not feel that things are getting better until the first half of next year. That's not abnormal. And I want to throw that out there. Yeah,
no, absolutely. I think looking back at history again, markets kind of sniff out when the worst is over, and before you see it in the mainstream media and in the paper headlines, magazine headlines, the market's going to sniff that out and recover before news gets any better.
Absolutely. It reminds me of 2009. In 2009, the market bottomed in March, but it didn't feel like things were getting better until October, November that year. Yeah. Just to throw it out there.
Yep. Last thing I had was a tweet by Money Visuals that is run by our friend Ashby Daniels, and he said, clients don't hate bear markets because their portfolio has dropped in value, but because they don't know how long it will take to recover. It's why you should discuss risk in terms of years of income and not in percentage asset allocation or risk scores. And I thought this went along really well with the first piece of research that I went over, because stocks and bonds are both getting whacked.
That's right. So how do you diversify?
And bonds are quote unquote safer than bonds, and a lot of them are still down 15 to 20%.
That's right.
So, I think the conversation that we've been having is, if you don't need this money in 1 to 3 years, let's just let this process play out and let it recover. And I think we're going to get back to a normal environment. But I think the thing that scares people is they don't know how long this is going to last.
Yeah, and when you're in it, it always is going to appear it's going to take a lot longer to normalize than it actually is. Two great examples. You go back to the sell-off in February, March of 2020. There was no way people thought the market was going to rally the way it did the rest of the year.
Right.
Okay? Example A. We were different, though. Don't mean to spike football. Another analogy is TSA.
Miss that out of you.
I have to once in a while. Another analogy I have is, travel. And so when COVID hit, all the experts, quote unquote, were saying airline passenger volumes are not going to recover for at least 6 to 7 years just after 9/11. Same analogy. And it took 2 years, and we've now surpassed pre-COVID passenger air travel levels. So it's like when you're in these environments, it feels like it's going to take 3-4 years for this market to recover. Could shock you.
Yeah. Yeah,
this market has the ability to move and move very quickly.
Mm-hmm. And I think people are thinking this is going to be more drawn out just because of the quick violent corrections and bear markets that we had recently, like you said, February, March of 2020, and then end of 2018, that was pretty quick. It was just like a month or a month and a half that was pretty severe, and it came back very quickly. And this one's taking a little longer. So I think people are getting antsy that, hey, this is going to be more like an 07, 08, where it's going to be 2.5 years before the market starts to recover.
That's right. And what's the difference right now? You don't have the whole monetary financial system at risk of imploding. And so, when I have people sit there and say to me, this feels like, 07 through 09, and though the returns in certain asset classes are similar, the underlying reasons for the sell-off are completely different. And that would be trying to compare apples to oranges.
Yeah, I think so too. So I think we just need a period of calmness in the markets, right?
And it will. It'll happen. I'm not saying how quick it'll happen, but things always go through these types of cycles.
Yeah, they do. They do. Turn it over to you.
I got some good stuff.
Haven't heard that in a while.
I got some good stuff. Okay. So the first thing is we are charting new territory. Jenna's going to put up on our for YouTube viewers this chart right now. And for our listeners, they can get it off of our show notes. Remind our listeners where they can get this.
Yeah, on Twitter at Jessup Wealth or Jessup Wealth Management on Facebook or LinkedIn.
So this is a tweet from the author of the Lead Lag Report, Michael. It shows the 20 largest S&P 500 drawdowns going back to 1961, Mark. On only 3 occasions did treasuries during those stock market drawdowns lose money. What happened this year, though, has no precedent. And he said risk off became risk on in correlation and behavior. And when you look at this chart, it'll show you like the drawdowns of, say, during the great financial crisis of 07. It'll show you the dot-com bubble sell-off. And it shows you how far the S&P sold off. And then in purple, on the positive side, it shows you what 20-year Treasury bonds did in that same time period. And in most of these instances, they have done what they're designed to do from a diversification standpoint. Stocks are really weak. People go into the safe haven of long-dated U.S. Treasuries. And what do you see different about this chart?
They're both falling right alongside each other.
You virtually have what is deemed to be the go-to safe haven in the market sell-off down virtually the same as much as stocks.
Yeah. And it's interesting because if you look at this, from 2007 to 2012, stocks were off more than 55%. And in that same time period, 20-year Treasury bonds were up over 50%.
See what I'm saying?
So
okay.
there is not a historical analog.
There's not. And a real quick stat, and if Jenna has time to put it up on the YouTube, this chart right now, it shows government bond returns going back to about 1900. The last year was the worst year for returns for the World Government Bond Index going back to the Civil War.
Wow.
I did not misspeak. 1865. Okay?
That's a long time.
Now, to prove this correlation issue, my next item, and this is where it's really going to hit home, right? This is just a sucker punch right to the face. Okay? It shows going back to 1977, a chart by Compound Advisors, and it shows years where the stock market struggled, what the Bloomberg Bond Aggregate Index did, and then the blended return of your prototypical 60-40 portfolio. I want to highlight 2008. In 2008, the stock market, the S&P was down 37%. That year, the aggregate bond index was up 5.2. So your blended return for your typical 60-40 portfolio, you were down 20%. And that was a horrible year.
Yeah, okay? Brutal year. But still 17% better than if you were 100% stock.
Bingo. So what worked that year? Diversification worked properly that year, right? So let's fast forward to this year, the beginning. So when this was run through the end of June, Mark, okay? S&P down 20% for the year. Aggregate bond index at that time down 10.4%. So tell the viewers and listeners what the 60/40 is down.
Down over 16%.
So if you're listening to this or watching this and this feels like 2008, from a return perspective, you're spot on. From what's going on in this world and you look at what's really affecting these markets, completely different scenario from 07 to 09.
Right.
That's why I'm in the camp that the next couple of years, you're most likely going to have a friendly investment environment. This has taken a lot of risk out of the market, at least for the next 2 years. I'm not saying it's going to be peachy keen. It's going to be up a little bit every month. It's going to be nice and easy. The bottoming process still has to finish out, and it's going to suck. But I'm just saying, when you look at these types of numbers, it's no reason why people are on edge.
Right, exactly. And I think, so let me ask you this. So, the Bloomberg U.S. Aggregate Bond Index is down almost 10.5% this year. You know what would really shock people?
Go.
If it finished in the green for the year.
Oh! All right.
So the other thing we have to remember, too, is this is only the first 6 months of the year. And just because we only have 6 months left doesn't mean damage can be undone in that short a period of time. So it wouldn't shock me if bonds finished up for the year. There's so much negative sentiment on bonds, and bonds are never going to work again. Bonds should be tossed out of the 60/40 portfolio is dead. But
the minute people start talking about the 60/40 portfolio being dead, that's proof within itself it's not.
6 months is enough time for these numbers to climb back.
Absolutely.
I'm not saying they're going to, but you just have to have an open mind with that.
I would say just as much of the risk to the downside the past 6 months that the market has had, people need to get imaginative and understand that this market could move quickly on any sort of positive news.
Yeah.
Okay. So the next one I have, I think you'll find interesting, Mark. This is a tweet by Julian, who's the CEO of Accelerate FT. His tweet, which was on July 2nd, said this: small cap stocks trade at 11.2 times forward earnings, in line with low valuations hit during the bear market bottoms of 2008 and 2020. Small cap valuations have dropped more than 55% over the past 2 years. And what it does is it references this chart that goes back to the beginning of 2006, and it just shows the price to earnings ratio on a forward-looking basis. Why am I highlighting this? I know that in the news and even on our podcast, we tend to kind of reference the S&P as kind of the poster child to kind of reference and benchmark and talk about stocks. I think it's important that once in a while we bring up some other things like the S&P 600 Small Cap Index, which has high correlation to the Russell 2000, which you tend to talk about in the pricing at the beginning of the podcast. I think it's nice to highlight that it's not just large caps that have really struggled. I mean, you have small size companies that are at really depressed and at decade low valuations.
Yeah, and I think the thing to remember here too is we kind of talked about this during COVID, is that coming out of recessionary periods, and I'm not saying we're in one yet, but if it does happen to be that we're in one now or we're close to one, small caps by definition are more volatile than mid cap or large caps.
Absolutely, less liquid, etc.
And so, these more quote unquote riskier areas of the market tend to lead the market in both directions, right? Mm-hmm. So if you think about the end or the middle of 2021, small caps kind of stalled and petered out before the general market did, and they kind of led the market lower. Go back to February, March of 2020, small caps kind of led that rally higher. So coming out of recessionary periods, looking back at the past, small caps tend to turn around before the large cap indices do. So I think that's one of the tells, not the only thing, but to see signs of a improving market and a market that is strengthening and has already priced in all the bad news. Once small caps start to turn around and outperform on a relative basis for a couple of months, I think that's a pretty strong sign that a lot of the damage has already been behind us.
Well said. well said. And the only thing I could add to that is I would expect at these types of valuations for the next couple of years, mergers and acquisitions to pick up in the small cap space. I think you're going to see a lot of either other smalls or mid and large size companies say, that company would be complementary to our business, whether it's a competitor, supplier, customer. I think you're going to see, with these types of valuations and small size, you're going to see a lot more acquisitions in that space.
Yeah. And speaking of that, I'm going to make a prediction, which I don't do too often, but this is just for fun. I think Apple is going to buy Peloton eventually. And I came out and saw, because we're big Peloton fans. Yeah. And they're making, Apple's making like special bands or Peloton's making special bands for like Apple Watches or something like that. I saw the other day. So I just have a feeling this is like the beginning of that.
Setting up the acquisition.
Right. Buying them on the cheap. With all that cash Apple's got on the balance sheet.
They'll probably make it in a day.
So. Right. So just one prediction. We'll see if I'm right.
That's a good prediction.
See if I'm right. See if I'm wrong.
Okay.
So, all right. Well, I'm going to head out of here. I'm going to bring in Taylor for the financial planning topic of the week. And I will be back with everybody next week on episode number 158.
All right. Thank you, Mark. So for our viewers and listeners that are newer to the podcast, Taylor Ledbetter is a wealth advisor with our firm, Jessup Wealth Management. She is in charge of all the financial planning work that's kind of done behind the scenes for our clients. She has a very important test coming up that she has been working her tail off on for quite some time. Before you begin, Taylor, you want to tell the listeners and viewers what's ahead for you over the next week or so?
Mm-hmm. Yep. So I've been studying for the Certified Financial Planning Exam, CFP exam. It's about a 6-hour test. Takes a few months to study for, so I've been here at the office 7 days a week ever since January.
Yeah,
probably.
Yeah, more than
studying.
A few months.
Yeah, so I take that in about a week and a half.
You're going to do great.
Thanks.
You're going to do great. You're very smart. So you've been working hard on it. So what do you have for the viewers and listeners this week?
Mm-hmm. So today I'm going to be talking about just the differences between a traditional IRA and a Roth IRA.
Okay.
Because I actually get this question very frequently in meetings and then in financial plan presentations when I do those. I would say it's probably the most commonly asked question.
All right, let's do this. This is going to be
fun. So first, traditional IRA contributions obviously go in as pre-tax money. Mm-hmm. And then when you go to withdraw those in retirement, you pay taxes on those. And then with the Roth IRA, contributions go into that with after-tax money and grow completely tax-free, and then when you withdraw that in retirement, you don't owe any taxes. Mm-hmm. That's, I think, the main difference, the biggest factor. Typically, if you have a traditional IRA, it's more advantageous if you're expected to be in a lower tax bracket in retirement, because if you're not paying taxes on that now and you expect to be in a lower bracket later on, you'll just pay less taxes.
Sure.
And then kind of the opposite for the Roth. If you expect to be in a higher tax bracket in retirement, it's better to pay those taxes now when you're in a lower bracket.
Yep, makes sense.
So that's, I think, like I said, the main difference between the two. Some similarities would include they both have contribution limits. Mm-hmm. So for either IRA, you can contribute $6,000 a year. Or if you're over 50, you can contribute an extra $1,000 for a total of $7,000. Typically, there is a 10% penalty if you withdraw money from either of these accounts before age 59 and a half. Now, there are a few exceptions. A couple examples. If you're buying a home for the first time, you can withdraw money before 59 and a half up to $10,000 and avoid that 10% penalty.
You'll still pay tax on it, but you just avoid the penalty.
Correct.
Yeah.
From the traditional IRA, at least,
Correct.
You would pay taxes. Another example is if you're withdrawing money for qualified education expenses, you don't pay a penalty on that either.
Okay.
But those are really the only similarities between the two.
Yeah.
There's actually quite a bit of differences. So as I just mentioned earlier, traditional IRAs are taxable, Roths are not. Traditional IRA contributions receive a tax deduction when you go to file for your tax return, since you're not paying taxes now, that's subtracted from your taxable income.
Yep.
Traditional IRAs have what's called a required minimum distribution beginning at age 72 because the IRS wants their tax money.
They want to start getting that money.
So they require you to take out a certain amount every single year starting at age 72 for the rest of your life expectancy. And if you have beneficiaries on your traditional IRA, they also have RMD requirements upon your passing also.
Correct.
Typically, if you're a non-spouse, you have to deplete the whole account within 10 years over time. But with Roth IRAs, since taxes have already been paid on that, your beneficiaries don't have to take out any money. They're not forced to.
Yeah.
I've mentioned this before. With a Roth IRA, you can do a Roth conversion. It's just converting traditional IRA money to a Roth IRA, paying those taxes now and letting that grow tax-free in retirement.
So that one-time hit, and then that money's in the Roth for the rest of its life.
Correct. You used to kind of be able to do the same thing with the traditional IRA. It was called a recharacterization. That was when you would move money from the Roth to the traditional. So it worked a little bit differently, but the Tax Cuts and Jobs Act of 2017 banned those recharacterizations, so you can't do those anymore. Another difference is that you can withdraw your Roth IRA contributions completely tax-free.
That's a big point.
Because you've already paid taxes on those, whereas a traditional IRA, you can't withdraw the contributions tax-free because you haven't paid taxes on those.
That's right. They can't get you for double taxation on that.
Right. So again, you can withdraw the contributions to avoid the penalty, not the earnings.
Not the earnings.
Anytime before you're 59 and a half.
Correct.
Another big difference between the two is that Roth IRA contributions need to remain in the Roth IRA for at least 5 years from your first contribution to avoid that 10% penalty.
Correct.
So there's a 5-year holding period. The next difference is that there's actually an income phase-out range for traditional IRA contribution deductions, because as I said earlier, you can deduct what you contribute to the traditional IRA, but there are phase-out ranges, specifically if you're active in a qualified plan, so a 401k or a 403b. So for example, if you participate in your 401k at work and you are married filing joint on your return, if you make combined $129,000 or more, then you can't deduct any IRA contributions on your tax return.
You can still make the contribution, you just don't
Correct.
get the tax benefit.
Correct.
Yes.
So that phase-out range starts at $109,000 and then ends at $129,000.
So completely after 129, there's no deductibility of it.
Correct. And again, those numbers are for the married filing joint.
Correct.
And then the last major difference is that Roth IRA contributions are phased out as well on a certain income level. So if you are single and your modified adjusted gross income is between $129,000 and $144,000, that's the phase-out range to where you can't make maybe as high of contributions to the Roth. So that phase-out range ends at $144,000 if you're single, and anything above that, you can't contribute to a Roth IRA at all.
Correct. Correct.
So those were the main differences. There's a lot of them when you start looking into it.
Yeah, there's a lot of differences between the two. I think more and more where I'm seeing people have both of these buckets of money is inside their 401k plans. And what I'm seeing more and more of, Taylor, is, you get a 401k statement, and let's say it shows a participant has, $500,000. Well, it might be $350 or $400 of it is pre-tax money, and maybe they started when the plan added in an after-tax saving, bucket, like a Roth bucket. They're going to have some of that after-tax money in that plan as well. And so I think this could be another good reminder for listeners that, if you're participating through an employer-sponsored plan, look to see if they have an option to make those after-tax Roth contributions, because you might not be eligible to do a personal Roth IRA.
Right.
But guess what? You might be able to do it through your plan.
And I think having both, tax buckets of money is a good thing.
Yeah, I mean, for someone like you who does the financial planning portion and you're advising clients on the most, say, tax-efficient way to do withdrawals, the more tools that are at your disposal on behalf of that client is going to get them a more successful outcome.
Yeah, and I think when I talk about the Roth IRA or a Roth 401k, just those after-tax accounts, a lot of times people can be like, oh, well, that sounds like the better option, so let's just go ahead and do that. But even though it sounds better, it's not always the case.
Well said.
Kind of
well
like
said.
I referenced earlier, if you expect to be in a lower tax bracket in retirement, maybe a Roth right now isn't, a good option for you.
Well put. Well put. And I think because it happens that, everyone says the Roth is better. And the other issue I see sometimes is someone, let's say they have a 10% contribution rate. And, they hear this podcast and they go, I'm going to start putting money into the Roth. So they switch their contribution from 10% pre-tax to 10% after-tax Roth contribution through the retirement plan. Your paycheck is going to drop by 4 to 5%. Because that money going into the plan has to be taxed first. And so what I see as a more successful transition for a lot of people is you make changes like every 6 months over 3 years. So if you're at that 10% contribution rate, maybe you drop that pre-tax to 8%, start increasing that Roth by 2. You're still at a 10% contribution rate overall. 6 months later, do another baby step. I think if they do it in baby steps, they're really not going to notice it on their paycheck.
Yeah, and that's what I tell clients too all the time is if you do everything slowly, maybe make changes, like you said, once a year or every few months, you're not going to notice that.
Yep, and
as
do
much.
it systematically, right?
Make sure you're consistent with it.
Absolutely. Anything else you'd like to discuss this week?
Nope, just wanted to go over those main differences.
Go ahead, please.
Oh, I did them.
Okay, making sure you didn't have anything else. I wanted to make sure you didn't have anything else. I didn't want to cut you off. So, as always, Taylor, thank you so much for spending time with us on the podcast. You're amazing. So, viewers and listeners, we're going to sign off from the Independent Advisors Podcast. This was episode 157. Mark will be back next week with episode 158, and we will talk to you then.
Thank you for listening to the Independent Advisors Podcast. If you're interested in hearing more, hit the subscribe button so you can be notified every time a new episode gets released. Feel free to share with friends, family, and follow us on Twitter at Jessup Wealth, Facebook, and LinkedIn. Mark and Matt will continue to share beneficial information on these social media sites. Also, check out the podcast tab on their website. That's www.jessupwealthmanagement.com. There you'll find links to every episode of the Independent Advisors. Have questions or topics you want to discuss on the show? Message us on Twitter, LinkedIn, or send an email with the words questions and topics in the subject line to inquiries@jessupwealthmanagement.com. We'll talk about it right here on the podcast. Certain sections of this commentary may contain forward-looking statements based on reasonable expectations, estimates, projections, and assumptions. Forward-looking statements are not guarantees of future performance and involve certain risks and uncertainties which are difficult to predict. All indices are unmanaged and are not available for direct investment by the public. Past performance is not indicative of future results. This podcast is provided for general informational purposes only and does not constitute either tax, legal, or financial advice. Although we do go to great lengths to make sure our information is accurate and useful, we recommend you consult a tax preparer, professional tax advisor, financial advisor, or lawyer regarding your specific circumstances. Investing involves risk, including the loss of principal. No strategy can guarantee any objective or goal will be achieved. Advisory services offered through Commonwealth Financial Network, a registered investment advisor.